Is it too late to buy properties this time in the cycle? How do we get the banks to lend us more when currently there's a credit squeeze? And some wise words from Jim Rohn, my mentor. That's what I'm going to be covering in this episode of Michael Yardney's podcast.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Welcome to episode 2 of the Michael Yardney podcast. And thanks so much for all the great feedback, the comments you left, the emails I got, and all the subscriptions on iTunes. If you didn't listen to the first episode last week, go back to michaelyardneypodcast.com and have a listen as I explained what makes an investment grade property and gave you some interesting thoughts in my mindset moment. Of course, if you haven't subscribed to iTunes, that's another great way of getting it as well. Now, today I'm going to discuss 3 things. First is a common question I'm asked. In fact, one of the most common questions I'm asked, is it too late to get involved in property at this stage of the property cycle, at this more mature stage? I'm also going to answer a question I received, and I received so many questions over the last little while to answer on this podcast, but I had to try and select one that a lot of people are asking, and it has a bit to do with getting stuck at the moment with the new lending rules. And even though you can afford properties, William asked, why isn't the bank lending me money and how can I get around it? And in my mindset moment, I want to teach you one of the lessons that I learned early in the piece that changed my way of thinking about all sorts of things, not just property investment. So I guess one of the most common questions I'm currently asked is it too late to get involved in property this cycle? Some property markets have performed so strongly over the last couple of years, leaving people wondering, is it too late? And you can understand why they're thinking that way. They wondered if they've missed the boat this cycle round. And it's partly because they've heard that timing is everything when involved in property investing. But I'll let you into a little secret. It's not really the case. Now, I didn't really understand this when I first got involved in investing, and I've very much changed the way I think about countercyclical investing, because when I first got involved in property, I was told that smart investors aim to acquire their assets countercyclically in markets that haven't experienced recent booms. And I guess that's one of the reasons there are all these hotspotting websites around. In other words, the basis of countercyclical investing is to follow Warren Buffett's advice. Remember, he said, be fearful when others are greedy and be greedy when others are fearful. And my mentors taught me that understanding the recurring relationships between the different stages of the market cycle was critical to maximizing the returns on my investment dollar. It also suggested that if you countercyclically invested, it minimized your risks. And that actually seemed to make sense. If you know where things are heading and buy before the crowd does, buy before prices start rising strongly, you're likely to make big profits. But over time, I realized that's not always the case. In fact, if you wait for the right opportunity countercyclically, you'll often be left behind. So now I'm no longer a big believer in countercyclical investing because I realized that timing is actually one of the most misunderstood concepts with regard to investing. The truth is, successful investors know how to create wealth at any point in the cycle. Timing definitely matters, and there's no question about it. Of course, you don't want to buy a property at the peak of the boom just to wait 3 or 4 years for its value to start rising again. But successful investors find that timing really isn't that important. Have you noticed how some investors seem to do well in good times and do even better in bad times? Market timing really isn't that important to them. On the other hand, others do poorly in good times and they even do worse in bad times. Market timing really doesn't have much effect on them either. Now, that's interesting, isn't it? So what is it that differentiates that small group of successful investors from that crowd who, in general, don't do that well? And the fact is that at the same stage of the cycle, successful investors manage to make money, while unsuccessful investors lose money. And it suggests that it's not the external world that determines whether you make or lose money. It's something inside us. So I know some of you would be arguing, well, okay, it's knowledge that differentiates these two classes of investors. They know more, they've got background information. But I'd argue that's not quite right. Sure, they may have a level of knowledge and financial fluency the average investor hasn't got. Yet knowledge alone doesn't make them successful investors. What allows some people to become super successful investors, in my mind, it's actually their mindset, the way they think about money and wealth. Look, in his book, The Tale of Two Cities, Charles Dickens famously wrote, "It's the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness." Amazingly, things haven't changed that much since Dickens wrote that way back in 1859. For some people, the current stage of the property cycle makes some of the best of times. And for savvy investors, the current times are giving them opportunities to buy top-class assets that'll help them set up their financial independence in the future. These people, they see abundance. For others, these are the worst of times. Some only see the negative media, property prices are at record highs, banks are tightening the screws on property investors, there's lower or no capital growth in some areas. They're worried. There's some other investors who are saddled with investment debt secured against the wrong type of investment. Properties in regional areas, mining towns, locations that just haven't gone up in value. So they can't see the available opportunities. They don't see abundance. They see scarcity. They feel fear. So I guess what I'm trying to say is you need much more than just knowledge and facts. As I've explained, it won't assure your success. I've seen some very knowledgeable people make some pretty foolish investment decisions. Interestingly, while some investors are still getting in the game at this stage of the property cycle and buying great investments to help secure their financial futures, others are waiting for the timing to be perfect. Look, only last week I spoke with David, who's been waiting, believe it or not, for close to 10 years for the time to be just right to start investing. Look, of course, the timing will never be just right. There'll always be challenges, situations, circumstances, obstacles, fears, doubts, and things that you're going to have to overcome. The timing is never going to be perfect. 10 years ago, David saw some obstacles and he actually didn't get into property investing. If he did, chances are if he'd bought a well-located property in one of our big capital cities, it would have close to doubled in value. And even if he paid a little bit too much, even if he hadn't bought in the exact right spot, even if he got his timing wrong, he'd be worth a lot more. Wealth is attracted to people who make decisions. Wealth is attracted to people who are committed. If you're waiting for the timing to be perfect, the timing will never be perfect for you. Currently, property investors are being given some great opportunities to buy properties as the markets have slowed down a little bit, especially from the frenetic pace of the last couple of years. Personally, I've been adding to my portfolio, and I did that last year, and I did that the year before. I'm not timing the market. I'm not worried about the stage the cycle's at. The list is long of wealthy Australian investors who sowed the seeds of their portfolio with remarkably poor timing, like those who bought at the advanced stage of the property cycle in 2010 and the property market slumped for a while, or those who bought just before the global financial crisis in 2007 and 2008. And look what happened afterwards. The market stopped. We thought the world was coming to an end. And look what their properties are worth today. Or those who invested in 2003 and 2004. And it was much the same in the 90s, in the early 90s when we had the recession we had to have. These successful investors were busy doing while others were pondering. Yes, we're moving into the next stage of the property cycle, and sure, we're going to see some major changes in the economic landscape. While the timing might seem unfavourable to some property investors right now, others are going to do very well over the next few years. But that's the way it's always been. I'm certain 10 years from now there's going to be a group of successful property investors who are going to tell stories about buying properties when everyone advised them not to, when everything seemed difficult, when the media was negative. They were buying properties right now. The bottom line is, while I understand the concept of countercyclical investing, and it's definitely important that investment timing is considered, precision perfect timing is not really necessary for successful property investing. The top and the bottom of the cycle are only 2 days out of the entire cycle, and you can't just pick them. The financial wizards, the economists, the PhDs usually can't pick them either. And there's always going to be some good individual investment opportunities at all stages of the cycle. Because remember, you're not buying the market. You're buying individual properties in the market, what we call investment grade properties. And if you're not sure what I mean by investment grade properties, go back to episode 1 of this podcast. You can find it at Michael Yardney podcast, where I explain why currently on the market most properties aren't investment grade and how to choose one. You see, when I first started investing, I knew nothing about property cycles. In fact, I knew very little about property at all. And if I'd waited for the right time of the cycle, the right market sentiment, I probably wouldn't have started at all. So the lesson here is to maximise your opportunities in the upturns, all the while being prepared for the next downturn.
You're listening to the Michael Yardney podcast, where each week you'll learn new ideas about property investing, success and money in 20 minutes or less. This show is brought to you by Metropole Property Strategists.
A couple of weeks ago, I sent an email around to my database asking for some suggestions and ideas about the topics you'd like me to cover on this podcast. And also, I gave you the opportunity to ask me questions. Now, any question I answer on air, I'll be sending you a copy of one of my books plus a DVD set. So that'll be valued at about $100. I had so many questions, I'm going to do some specific episodes of Ask Michael Anything questions to help get through a lot of these questions. But today I chose one that is a very common concern of lots of investors, so it may be related to you, and it's from William Henkin in Tarragindi in Queensland. Thanks for sending it in, William, and you're going to get your gift in the mail. And it said, Michael, I've got a portfolio of $1.2 million and have reached somewhat of a serviceability window at present. I'm 26 and looking to semi-retire in the next few years with a self-serving portfolio. Our plan was to buy another $600,000 investment property, and based on your serviceability calculations, you say you can afford it, but the bank won't lend you more. So you're asking a few questions, and basically one of your questions is, should you now buy cash flow positive properties to increase your serviceability in the bank's eyes? Great question, William, and you're not the only one. So first of all, I should say congratulations, because if at the age of 26 you've got $1.2 million worth of properties, you've done well. Now, I don't know if they're investment grade properties. I don't know what your loan to value ratios are. I don't know enough about you. So this is a very general comment. But the answer is you're going to need a substantial net asset base to retire on your property portfolio. How much do you need to retire? That's a fantastic question, and I'm going to cover that in a future podcast. But if you're aiming to do that in the next few years, you're probably going to be a bit disappointed. You see, I've found that it takes the average investor 30 years to become financially independent. 30 years, Michael, some of you are saying. Yeah, see, it takes 8 or 10 years to learn what not to do. Most investors get it wrong. And then it actually takes them 4, 5, 6 years to unravel the mistakes that they've made by buying the wrong sort of maybe not investment grade properties. And then it usually takes 2 good property cycles to build a substantial asset base. Because remember, in the future, you're going to need your own home without debt against it, as well as a substantial asset base, because you won't be able to live off the cash flow of your properties. So may I please mentor you, William? First of all, sometimes the right thing to do is nothing. We're currently in a credit squeeze. You're right. You, like a lot of other listeners to this podcast, are very likely able to afford out of your cash flow and out of your cash flow from your personal serviceability or your rents to buy another property. But the banks are currently being squeezed by APRA. We're having what's called responsible lending, but maybe they've gone a bit too far. You're right. So that what's challenging a lot of investors currently is that you've got to be able to service all your debts, all your investments, at not the 4 or 5% that you're paying today, but at 7.5 or 8%. And even if you haven't got interest and principal loans, you've actually got to be able to pay principal and interest as well, which are higher repayments. So like you, William, lots of investors are being cut out at the moment. So what should you do? Back to my previous comment, I've made more money in the past by saying no to things than saying yes to things. So sometimes the right thing to do is nothing. Just to have a break, because you can't buy properties every year. Property is very lumpy. You buy one and then it takes a couple of years, and then you buy another one and then it takes a couple of years. Then you may be able to buy two. So wanting to buy 10 properties in 10 years, like some people are saying, it's unrealistic. So what you've got to do is wait for the cycle to move forward and for your properties to increase in value and the banks to slowly lower their criteria like they always will, because they're money shops. They actually want to lend you money. That's the only way they make money and pay their shareholders money. Should you buy a cash flow positive property? No. And the reason is your cash flow positive property may give you $5, $10, $15 a week positive cash flow. That won't be enough to change your serviceability, but assess your total borrowing capacity, including that on your cash flow positive property, on these new stricter criteria. So any extra loans you have is going to make it difficult for you to get any further loans. It won't help you. So how do you make yourself more attractive? Well, first of all, go to a smart finance strategist, because they can often work through the maze of lenders at the moment. Make sure you own the right sort of properties, the ones that the bank see as a good investment and will be prepared to lend higher loan to value ratios on. Maintain a good credit rating. Protect your credit rating. Maybe you should go and check out your credit score. Avoid having bad debts or blemishes on your credit score. Lower your credit card limits to make yourself more attractive to the bank. Have a stable history of employment. There's lots of ways of making yourself a bit more attractive to the banks, but despite that, the banks are currently being very selective. So, William, congratulations on what you've achieved so far. Now time for a little bit of patience. What I've always suggested is you should assess your portfolio once a year, and if there's time to do something, you do something, and if not, just hibernate. Get going with your job, enjoy your life, enjoy your loved ones, and come back a year later and review how's the situation, how's the market, what's happening, is it time to do something else again? Thanks for your question, and if you've got a question for me, please leave it in the comments section at the bottom of michaelyardneypodcast.com.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Each week in Michael's Mindset Moment, I'm going to share some of my thoughts about why the rich keep getting richer, why successful people become more successful, and it all has to do with their mindset. Remember, you can't drive a Lamborghini with the engine of a Hyundai, so it's going to be your job to upgrade your wealth operating system, and each week I'm going to share with you some of the habits of the successful people in my mastermind group and some of the very successful clients and people in my mentorship program that I've worked with over the years. And today I'd like to leave you with some thoughts of Jim Rohn. The late Jim Rohn was one of my mentors, and he said, "Don't wish it were easier, wish you were better." He said, "Don't wish for less problems, wish for more skills." He said, "Don't wish for less challenges, wish for more wisdom." You see, when life happens, we can choose to either be the victim or the victor. We can run away from our failures, or we can use them to catapult us to our dreams and our successes. As a property investor, as a business person, as an entrepreneur, you're going to be faced with changing landscape daily, both things you want and things that you don't want. But it's your mindset and your passion for improving every day through consistent action and execution that's going to separate you from the average person. Remember, he said, don't wish for less problems, wish for more skills. We can't grow in other areas without challenge. The key is to understand the challenges and then acquire the skills to overcome them. I put this particular quote into action anytime I'm faced with a problem or a challenge, keeping in mind that only by acquiring more skills can I overcome it and create a profit. Look, I'm the CEO of a large national company because I can solve problems. Your pay level, what you achieve, will depend upon the problems you solve. Years ago, one of my mentors taught me, when I was having challenges at work and things were annoying me, "Michael, you're the boss because it's your job to solve problems, because you can. If you couldn't, other people would be the boss." So let's finish this session with just a recap of those clever words from Jim Rohn. Don't wish it were easier, wish you were better. Don't wish for less problems, wish for more skills. Don't wish for less challenges, wish for more wisdom. Well, there it is. the end of episode 2 of Michael Yardney's podcast. Thanks for listening. Today I shared with you why I still think it's a great time to get involved in the right sort of property investments at this cycle. We answered William's question about his challenges with the banks. I gave you some of my thoughts from Jim Rohn, the lessons I've learned from Jim Rohn. Now, if you got value of listening to this, please leave me a review, and I'm going to read it out on future shows. Just go to michaelyardneypodcast.com/review, and I'd really appreciate it. If you'd like to gain instant access to the show notes of this, just head across to michaelyardneypodcast.com. Now, watch out for our show next week when you're going to learn some new things about property investment, success and money in around 20 minutes.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.